Hey, Veta VA, welcome to another Tuesday Night Live where we're going to just tackle topics that have come up more frequently than not inside the Veta VA community on Facebook. Look, if you're not listening or being a part of the Veta VA community, please join us at any time. If you're catching this in a podcast replay or YouTube, we'd love for you to subscribe, follow along. We cover all sorts of topics, no solicitation, no cursing. It's an open dialogue, but you got to be a veteran, an active duty soldier, or a family member of either to join the Veta VA Facebook group. And if you're a professional listening in, we'd love to have you join as well, but we have a professional group just for you, moderated and engaged. Now, tonight's topic, we are actually going to talk about some of the things that come across. Like I mentioned, the VA loan, the most expensive way to buy a home, ? Yeah, I don't think so, but that's the question we get sometimes. And frankly, it's the question that's proposed when our veterans and active duty service members and their families are going out to buy property. Sometimes they're being referenced and told, hey, don't do that. You got some cash, do a conventional, do an FHA, do a USDA, don't use your VA earned benefit. Look, the VA benefit, it was a contractually earned loan product. There is no other loan product like that in mortgage. So to talk with me about this tonight is Byron out of Washington and a veteran himself, Army. Yes, soldier, sir. Right? Love it. Say something, Byron. I got to make sure your microphone's working.
All right. Say something.
All right. Love it. Byron Thomas, what does the rest of your shirt say? Byron Thomas 24?
Yeah, 24. Hey, we're going to enter this election and change the way things are done.
Veteran and loan officer. He's going to finance all the dreams. I love that. And then with me as well as Jerry Avila. Jerry, say hello there, buddy.
Hey, how's it going, everybody?
You are located down in Southern California, correct?
Correct.
Nice.
Yeah.
Sitting
beautiful
in LA
Ventura
traffic.
County.
Fun. Okay.
Yeah. Away from the LA traffic. I'm in just the coastal area, so I love it.
Pretty sure if you're in LA, you're in LA traffic. I think that's how that goes. Something
anywhere near it. Yeah.
All right. Well, man, guys, it's good to have you here with us. We might be having a little bit of problem getting the stream in the main group, but we're going to just definitely put this recording in the main group, and anybody can catch along on Facebook. So let's dive into the topic here, guys. Now, there's a couple of resource points we'll talk about towards the middle or end of this, but let's start out with this. Like, is the VA loan the most expensive loan? I think to understand that, we have to lay out a couple key things. What are the other loan types that we could be talking about in comparison, right? So what else do we have in comparison to the VA loan? What are some of those other loan types, guys?
So go ahead, Byron. You go.
Conventional, FHA, USDA. There's lots of options out there. And then there's some non-QM stuff where it gets weird fast.
Yes. So let's put a couple key corral moments around that. Let's put these horses in the right stall here. Okay. So conventional usually has a 5% down. Sometimes you can find less down, depends on the lender's expectation. But every time you go less money down, you go higher mortgage insurance premium paid monthly. Now, mortgage insurance premium does not cover you, Mr. and Mrs. Buyer, in the case of foreclosure or something bad happening on your home. It only covers the lender, and only for a percentage at that. So it's a little bit of insurance for them that you pay all of the cost on. FHA loans, now they'll be much more forgiving when it comes to credit scores, and down payment is 3.5% minimum. It has some upfront mortgage insurance premium that's actually calculated into the loan amount. And then it's got a monthly mortgage insurance premium that's paid. It's less than conventional most of the time, depending on your down payment on conventional, but it's always there, and it's there for the life of the loan. Unlike conventional, you can't drop it off when your equity hits a certain position. You've got to refinance out of it. So that's something to keep in mind. And USDA loans, man, they are great loans if you qualify with the property you want to buy and you qualify with the income for your family size. So when we say expensive, you have to look at it as a sliding scale, right? Byron, you're into racing cars. What's the most expensive race car that you drive right now?
Mine. It comes directly out of my pocket every time I break it.
That's right. And you're probably a few six figures into that thing over the last few years that you've been working on it and playing around with it. And so I'm not asking you for real numbers. I don't want you to get embarrassed. That's a private.
Don't put this out there, man. Like
no, but what I will say though is that sounds terrible to me, but this is something you do all the time. So by comparison, this is something you're into. So that cost comparison is probably a little less for you than me, as not knowing anything about race cars, going, whoa, what are we doing? Like,
Yeah,
my car
absolutely.
drives me to and fro. It does not go fast. So when we
Mine's just the
compare and
same.
contrast, yeah, yours looks
Ish.
better doing it though. That's for sure. Sounds better too. So we get into this cost comparison. USDA loans are going to be a lot. They're usually a lot more expensive because the income valuation and calculation needed to actually qualify it sets a margin where, look, the dollars are going to be there. Jerry, we don't touch it very many USDAs, do you? Have you seen very many?
No, I've done a few only because I live in an area where USDA is a little bit more common, just because we're in an agricultural area. Here, Ventura County, I mean, Oxnard is known for its strawberry festival, and that's what they grow out here: strawberries, cherries, avocados, and so you'll have those types of things out here. And because there's those large groves, you will have USDA become some of the options available for some of those more, woodsy areas of Ventura County.
Nice. Okay. So let's dive into something about the down payment, right? So when we talk about the expensiveness of loans, we have to look at a couple different. There's the cost of the loan, and then there's how much does it actually cost me to get into the loan. Two different conversations. Let's talk about getting into the loan, and that's the down payment required. FHA loans. Byron, what can you tell us about the FHA down payment requirement and how people come about it?
I mean, 3.5%, and it's not as painful as it could be, but when you're talking about $500,000, like, I live in a state where $500,000 is the minimum. On the western side of the state, 3.5% could take you a long time to come up with.
Just doing quick math, because I was about to say it out loud. What's that? 17,500?
Yeah.
Yeah. And that's just the down payment. That's not the closing costs, right? That's just so you can get into the home, and that's not even the equity you own immediately, because the upfront mortgage insurance premium is then added back into the loan amount. And so,
let alone, you have to take in consideration also the time frame of when you're buying, because certain months there's more impounds collected, and then that becomes even another nutshell that you gotta have to completely unravel for the consumer, and letting them know it's like, hey, now you got more taxes, more insurance are being collected up front, because we're sitting in a month where it's kind of you're right teetering right towards the next due date on those taxes and insurance. So
that's right.
Money out of pocket.
Even outside of third-party fees, the prepaids can affect your actual affordability on that loan as well. That is a big one. So FHA, the down payment, 3.5%. Conventional and jumbo. What do you guys know? I mean, Byron, you guys both live in areas where big loans happen because of just the cost of living down there.
Mm-hmm.
I mean, I'd like to say I do lots of loans from the E5 to E7 range, so we don't see as many jumbo loans out there. But I mean, jumbo loans can get more expensive very fast, really, depending on how much they want to borrow and what their rate is. Like, the in general increase in amount of money is going to raise their percentage up on that loan to start with, so their monthly is going to be a lot more, even if they have a big down payment.
That's right.
And certain communities are going to be worse than others when it comes to that jumbo loan, because so take into consideration just comparisons, right? I'm sure that Washington has the same as California does, where places like San Diego, Los Angeles, you're talking about $1 million plus being your conforming loan limit. And when that's the case, then you're talking about now having a much larger range in that 3% down if it's your first time buying a house using conventional, right? If it's your first time home buyer's option, the what is it called, home ready, home possible options, right? You have 3% down as a conventional buyer. Yes, it's cheaper than per se an FHA, but you have to have better FICO scores, and because of it, that really ranges that number on the interest rate quite a bit. And then once you go into jumbo, it can really get funky, because you then have to start talking. Yeah, it gets really expensive really quick. But then you also have to take in consideration sometimes other lending institutions will eat a lot of their costs because they were like, well, I'd rather have the big loans. And so you'll see a lot of that, happen in the market. And it just depends on the area that you're looking at. Ultimately, that'll always play a role.
I love it. That's wise words there. The VA loan, we talk about 0% down. Does that mean that loan is free?
No. There's always cost associated with a VA loan. I mean, there's less money out of your pocket up front to make it happen. But again, there's costs. Everybody's got closing costs. You're going to have to pay for some companies make you pay for your credit report, and you got your inspection to pay for. So there's always you're going to have a little bit of money to come in and actually execute the loan.
Yeah. Jerry, I lost your sound. Is it just me?
No, how about now?
Yeah, I got you back.
Okay. Yeah, that's my microphone. It gets funky sometimes. So what I was saying is that depending in the situation, right? Sometimes you have, your negotiations really matter at that point, because that's when you can say, okay, well, yeah, you can have your closing costs covered by the seller, right? And a lot of people get that confused with, all of a sudden now we didn't have any closing costs. It's like, well, no, you did. Let me break that down for you. You did actually have closing costs, but this is how it would have possibly been offset: either lender credit or seller credit, or a combination of both. And then you end up having the majority, if not all, of your closing costs potentially covered, depending really in the market that you're in. You do, let's say somebody gives you 3% of closing costs to a seller, right? 3% closing costs. That might satisfy you in, smaller states. California, not necessarily, because that is a massive number, and that total amount of closing costs is a lot of dollars, especially when you're talking about a $800,000+ home purchase. That gets expensive really, really fast. You're not going to get as much money from a much larger pool like that unless they've really got to liquidate. And I mean, that becomes a need of the seller to just make it happen.
The old fire sale.
Yeah. I mean, it's a lot easier to let go of $15K on a transaction that's, $500K home, then you're letting go $15K, versus that same 3% on an $800,000 home. Now you're talking about $24,000. That's not as easily equated, right? And so at the end of the day, that makes a big difference for some sellers. And so that's where, you have to really take in consideration. It's like, yes, there's always closing costs. It's just who pays for them is the question.
So let's talk about mortgage insurance. I led into it. You're talking about it a little bit. Mortgage insurance rules and regulations, right? When you get an FHA, mortgage insurance is mandatory. I don't care how much you put down. You're going to pay mortgage insurance. It's how they fund the potential losses. They're always backing themselves up, and that's just how they kind of keep the tap open for 580, 560 credit scores, right? And they'll allow that. So walk me through what mortgage insurance truly is, Barney style. What is it? Who pays it, and why?
You want to go for that one, Brian?
I mean, mortgage insurance really protects the lender or whoever is the guarantor of the loan. And you pay it to protect them, and you really don't have an option on it. It's part of the rules. Like you said, you don't get a loan unless you sign up to pay the mortgage insurance. Yeah.
And some of them will pay for it up front versus having it paid part of the loan. Some of them will be where they claim they don't have it, but it's actually lender paid, but it's all included into
the interest rate,
right? Yeah.
So it's all based on the interest rate, the note rate for that lender. Conventional loans, personal story, right? So I buy this house out in Texas, 10 acres, right at the back end of this great market, and I did not want to put all my cash into it, so I did conventional. I'm not a veteran; it is not available to me. Otherwise, I would have used it. I put 10% down because I was trying to keep as much cash, but keep my payment as affordable as possible. And I elected to take a conventional loan with the mortgage insurance premium. There was no upfront that I had to do, but it was a monthly amount. I want to say it was roughly about $270 a month. And I was like, okay, I can do that because I locked in a great rate, and I knew I could probably get that to fall off within the first 2 years. interestingly enough, while my value of my property came up, and I had an evaluation, right? So that I actually paid my servicer some money to do an evaluation of my property. They wouldn't knock off the mortgage insurance premium until they did the valuation after 2 years. And I kind of went back and forth with them because there is the Home Equity Protection Act, HOEPA, Homeowner Equity Protection Act, and that basically says that any homeowner can trigger a reconsideration on the equity to receive and retain as much of the equity as possible and lower their interest or lower their payment. They said, read the small print. And in the small print that I signed on my note, it did say I would have to hold that for 2 years unless there was a major improvement done on the property within that time frame. And I went, oh man, I missed that. So yeah, I think it was 25th month. I was like, hey, 2 years is up. I want this off. Like, let's go. And, I was right on my valuation and everything else. We hadn't done any major improvement, but I did get that removed and it made all the difference. But if I had done an FHA, which I have previously done an FHA arm, I remember buying my second home in a 5-1 arm. I had to pay that mortgage insurance till I refied it, and I knew what I was doing there. But mortgage insurance is good if you know how you're getting into it and understand you're going to make a portion of your payment that literally goes like throw it out in the ether or throw your dollars in the fire pit because there's nothing that's going to help you whatsoever. That is not for you.
You might as well just burn it.
What you're paying is being able to get that house for whatever you're facing.
Yep.
So VA, we say, right, we can totally say it does not have a monthly mortgage insurance payment. But conjunction junction, what's your function? Let's put these things together. It does have a funding fee, and that funding fee is what? Like, walk us through the funding fee structure.
So, if you are not a disabled veteran, you're basically going to end up putting down a small percentage of the loan to basically it's what you pay to play. Everybody pays it. It's something you can't get around. You could absolutely pay your funding fee up front at one time if you got the cash to do it. But It's something that's financed into the loan normally and just kind of the price of doing business here.
And then when you refi,
but yeah, go for it, Jerry.
But then when you refinance, you're gonna have to pay for all over again. Unless it's an IRRRL, then you're still gonna pay a portion of it, but just not the full amount. So that's how those, like, really at the end of the day, the funding fee is still something that's gonna either come out of pocket or be financed in. Same goes with the FHA UFMIP, right? You're gonna finance a portion of it right up front. In the same way, a VA is going to finance the funding fee for most people.
So you go into that, and I like how you said that, Byron, but I'm going to clarify something. You said disabled, right? That let's set the margin there. How much disability do I have to get to waive that funding fee?
What is it, 10%? It says you have to have something wrong with you. I've had clients who had no clue they were disabled enough to get their funding fee waived, buy homes, and be like, wait, what? I'm disabled? Because they have one thing, they have tinnitus or something where it's not a large thing. Like I'm 100% disabled. I've been blown up, shot at, and all that other fun, terrible things. All you have to do is basically breathe and go to the VA. And if you can get a rating, you're fine.
Yeah. Because the minimum rating is coming in around 10%, you get a 10% rating, that funding fee is waived. So now you're saying, okay, now 10% or more, there is no upfront funding fee. There's no funding, and that funding fee, like you put in, is actually added to the loan amount. So you could effectively
we can get technical about it too, though, right? On the funding fee, because technically speaking, you actually don't even have to have a rating a percentage. You just have to get a disability rating. Period. Yeah. Right. It's not even a percentage. It's not like, yes, I used to say the same thing. It's like, oh, the minimum 10%, they give that away like cookies anytime you have hearing loss, right? Done. But if you actually read it, it actually tells you, like, it is, as long as they receive a rating, period. It could be 0%, but still been given a rating. And at that point, they could be eligible to have that funding fee waived. And it just it'll show up on the COE when you pull it.
I love you calling that out, because that's one of those things that we just in the industry, you kind of get used to reading one thing and you just repeat it. You're like, oh, 10% is the baseline. Well, no, you could. We have seen some lower than 10%, but it's a rating, an officiated rating. So good call. I love that. Good call out on that. So the funding fee is upfront mortgage insurance. It is how the VA kind of funds the potential and the default on their loans in the future, and they guarantee 25% of that loan amount to the lender, which makes them feel all warm and fuzzy, like, hey, we're going to get paid even if this loan goes bad, right? That's all they're looking for. Every lender wants that, because the likelihood they can turn that loan after the foreclosure things back into cash and at least recoup most of their investment with the 25% from the VA, it's high. It's high that they can get themselves healed. So that's why they'll do
especially nowadays.
Yeah, the 500 credit score, the bang ups, all that stuff. They'll do it at 100% finance, and that's how. USDA, there is still some mortgage insurance due. This is an interesting thing, because you're talking about, it's 100% financing. Yes, but remember, risk is what we're always fighting against. There's a great book if you want to nerd out on underwriting and insurance and risk. It's called Insuring the Gods. It's fantastic history of how insurance came to be and how underwriting and gambling was like, they went hand in hand. Like, insurance and gambling is how it all started. And it started with shipping lanes and quite literally saying, well, I'll gamble this much money that this ship will come back to me with better wares. And if it doesn't, I'll lose this much money. And anyway, that's how it'll start. Crazy. So when you get into underwriting, you think about it. All an underwriter is absolutely trying to do is ensure that the bets fall in favor of the house. You'll repay the loan, or you'll sell the house, you'll sell a property and make enough money to make them whole while they're still getting the interest payments. Therefore, they're making more money. When you think about underwriting that way, it all starts to make sense. The house has to win. Otherwise, they won't write the loan. That's it. So the VA actually guarantees the house is going to win something. It's a better bet for them every time. Let's talk about interest rates a little bit, right? So interest rates, conventional versus VA versus FHA, USDA. What are you all thinking about that? What are you seeing in your active work right now? Remembering this is not an offer to lend. Any offer to lend or interest rates that you want to get from these guys would come with a conversation and an application to them, so they would actually be able to do that for you.
Yeah, I mean, when we're talking specifically govy loans, which is government funded loans, right? Or government insured loans, I should say. Those loans in particular are going to have lower interest rates, because the intention is that the government is trying to say, hey, use our type of loan because it's going to be better for you financially. And it's going to afford you more opportunity, especially when you're talking about the lower income houses, as well as those communities who end up having a little bit rougher credit and things of that sort. And so when you're talking about those groups, I mean, it's intended to facilitate first-time homebuyers to enter the home ownership marketplace, right? And so when you're looking at that, you're going to see, like, just in comparison, I mean, honestly, I haven't even looked at rates today. I've been doing back to school stuff today, but the last I checked, right, and depending on the circumstances, you have rates ranging anywhere on VA, FHA, and USDA, somewhere in the ballpark of, I'm going to say 6s to 6.5-ish. Just depends on where the lenders kind of sit with their compensation plans and all that. Versus a conventional, you're going to be more in the ballpark of a 6.75 into the, let's say, 7.375-ish, depending again on the purchase price, credit score, and all those other gambit parts.
So, what do you got, Byron?
My numbers are about the same as them. I do mostly VA loans. So when I randomly get a conventional loan, it always shocks me a little bit. Like these people are amazing clients. All the stuff, great credit score, great income, and just because they didn't serve, their rate's a whole point higher. I feel like it's fair, you know. Like,
hey, they didn't get blown up like you, bro. They didn't get blown up.
the recruiting office was open for you too, but you went to college and
Congratulations. That's how I feel. Thanks. I feel like you just called me out. Sitting in my beanbag eating Cheetos. I love it. All right. So, but the point is well made. The risk factor is higher on conventional loans than it is on VA because there's no secondary body out there saying we guarantee we're putting money behind that person because they qualify for this loan product. And that's the reality of what causes the interest rate to fall in the favor of the veteran without the mortgage insurance premium too. And frankly, no cap on amount to be loans to the veteran in the VA loan. We're talking millions of dollars if you qualify. You can do it.
2020.
Thank you, 2020, right? They just ripped that Band-Aid right off. Let me share something with you guys. I want some real life. I did not prep you with this. Ladies and gentlemen, I'm excited to show you. You can find this on vetava.com. It's our myth-busting paper with 2023's HMDA data numbers on point. Here is the comparative pricing analysis for 2023, all of 2023 nationally, loan type comparatively. You can see a few things here, right? So let's check out this origination column. As expected, 2.5 million in origination units for conventional loans to 306,000 VA loans, right? If you look statistically across the U.S., that actually matches up with who we have in our communities. FHA was 582,000 and USDA was 35,140. So you can see like even getting a USDA loan is even harder. Check this out though. The loan amount, average loan size. Yeah. The average loan size for VA loans was higher than the average loan size for conventional and FHA. So VA was writing out 375 on average, 375,000. Average combined loan to value, that's CLTV. That's like everything under the loan, including the funding fee, added to the actual loan or actual value of the property, their appraised value or what's remaining. 95% for VA, 95.31 is important. FHA, 95.34. So even though the VA loan does allow 0% down, they still on across the nation averaged out at 95.31 compared to conventional 79.11 CLTV. But just skip over.
Can I give a nugget on that specific?
Yeah, do it.
So what I love looking at this when we're talking about the CLTV, the reason why you see some of them that are coming in with a lower CLTV or loan to value in comparison, right? The reason it's at 95 is because you still have veterans that are buying the second time that they're buying a home, and they're retaining their original home, but because they are going over the amount, right? Let's just say they've already owned 3 VA loans or three homes with a VA loan. And out of those 3 homes, now they're down to their last bit, right? And then because of that, they're now they only have a certain amount of funding fee remaining. Well, they have to still come in with 25% of anything over that amount. And so because of it, that's why you have that CLTV actually coming in not at 100%, right? You're at 95. Right. And that's the reason why, because you have those buyers that are coming in actually having to give a down payment because they've already exhausted their entitlement.
So check out this column here on average interest rate on the right-hand side. Byron, to your point, conventionals came in average at 6.74 and the VA was 6.29. The FHA averaged at 6.48. So right there in the middle, right? And then USDA is just hanging out 6.5. Still the better interest rate, still the loan to value, still the higher loan amount for the VA loan. So tell me it's not a good idea. If you want to buy a house and you qualify with a VA loan, it makes sense, even in a market like 2023, where rates were up and prices were high. But if you had to get it done, man, that was the way to do it. This is the rest of that chart. Average net charges and credits. Average net charges were higher, were like just a little bit above conventional, because oftentimes you found space where the VA borrower had cash on hand because it wasn't their first purchase. And instead of putting money down on the property, they put money to buy down the interest rates, the discount points. You'll see that here's the difference. It's the 46.45 discount point buy down versus 42.96 for conventional. But even FHA had discount point buy downs because guess what? The seller can buy that down for them. Seller concessions are extremely grateful. So you may go, wow, that veteran had to come up with a lot of money. Actually, not necessarily. Seller concessions oftentimes make up the spread here.
Yeah,
because your average
that includes
origination
those 2-1 buy downs, right? Like those 2-1 buy downs made a huge difference for a while,
did.
where the seller was paying for the rate to come down 2%, and the seller or the buyer probably had some concessions already coming in from the seller to offset closing costs too. So now it's like the seller's paying for part of my closing costs, they're paying part of my rate, and now we're talking about I have money available to buy down my rate even further. Now I get to actually reap the benefits of this like wholeheartedly. Like, yeah,
I had a VA. This was their last home. This in 2023. She came to me. He was a teacher looking for his retirement in a couple of years, and Navy veteran, never used their VA loan. I'm like, what? This is crazy. So he comes in. They're like, well, we want to get it, and I think rates were popping around somewhere at 6.25. And by the time they had saved up all this money, and then they asked the seller, and the seller said, sure, we'll give you money. And so the seller pays like all the closing costs, which was less than 3%. And we locked him. And they're like, okay, well, what do we do with our money? I said, I don't know, but they wanted their payment at a certain level. I said, well, here's your interest rate options. And they bought their interest rate down almost a full point. And it was pretty inexpensive overall because that's what they wanted. And they got 5.25, I think, at the time, and an APR somewhere around 5.475 because we weren't charging them anything. And it was just nuts. So the VA loan is not the most expensive. It in most points of argument is the most flexible because so many invested people in that transaction can help cover the costs if needed and when negotiated.
Yeah, and then when you take the equation of the funding fee being waived because of the whole fact that they are disabled or they have that rating, automatically now, hey, funding fees waived. Guess what? Now it's even less expensive than your average active duty military, right? So at the end of the day, it's all about like, okay, where can we actually find it to be the most effective way for a veteran to occupy a home? Let's use the VA loan. It makes nothing but sense.
I'll tell you, if you're watching this now or later and you want a copy of that report, go to vettedva.com and you'll just find it in the professionals tab, myth busting guide. It'll be up there for you. So check that out at your leisure when you want. In fact, I just found that one link is broken, so I'm going to fix that real quick too. All right. While I'm doing that, we'll make sure this still works good. Okay. Let's look at this next topic point, which was the long-term cost analysis, total cost of ownership over time. You guys both have owned homes. You own homes. Like, walk me through what the long-term cost analysis is on home ownership and where that comes into play.
I mean, so this is my first home because I never bought one when I was in the service. Really, it's the cost I looked at was I'm going to lose money on equity if I don't buy a home now. I've been in this home a couple of years, and now my home is $100,000 more than it was when I bought it. And if I hadn't have bought it, it would have cost that. I wouldn't make that. So like that was when I looked at how much it was going to cost me to own a home, that was what I focused on, not upgrades, yearly maintenance, taxes, and all like the other things, whatever. I'm building a nest egg right now. So we could sell this place and go build our dream home somewhere else, This how I'm going to fund it.
Yep. Yeah, and when you're talking about home ownership in general, right? That is I think the overall benefit that nobody really talks about too much. But it's just like every time you make a mortgage payment, you're creating a cushion for yourself. On top of that, as the market grows and the market continues to go up in value on homes, guess what? That ends up more money in your pocket long term, because at the end of the day, if and when you have the need to refinance, right? Especially those who bought in the last 2 years, you've bought in the last 2 years, and let's say you hold on, you refinance in like 6 months, but you don't take out any money. You're just, let's just say you live it out for 5 to 7 years. The likelihood is that you're gonna see some returns, and just from me looking at what I would project over time, I would say even if it's at minimum of 5% increase in value, which is very low key, like very low for me, and in my opinion, But let's just say it's 5%. Who's going to give you 5% of money in return for doing nothing but paying for your mortgage?
Right, living in it.
Yeah, just live in it, and all of a sudden, and watch the other homes around you sell, and that now you made money. It's nobody's going to do that for you. So the simple fact is that home ownership provides that stability. It creates a foundation, creates stability, and at the end of the day, it actually even affects this part for many people, right? That reassurance that I have my home, this is my home, creates that psychological improvement for those that even suffer from their own traumas or whatever. And so you have that. It's more than money. It's security.
It's peace
and
of mind.
right. That's what I try. Yeah, it's peace of mind.
It is. It absolutely is. You know, I would even say to this point too, like I'm expecting that somebody watching this later is probably like, yeah, sure, guys. Like, you work in the industry, so it's always a good time to buy a home, and you just want me to write another loan. The reality is, I mean, most loan officers I know got in this industry because something triggered their own why, their own personal motivation point. Mine particularly as well. I did not think I could buy a home. I bought the home at the wrong time in 2006, and then the market did what the market does. But I fell in love with the industry because it changed my opportunity at 26 for what I knew I would be able to acquire and do in my life. So I now understand. I'm on my third home, and I did much better. I went from a 3-bedroom, 1 bath in the middle of a town to I'm on 10 acres in North Texas, right? And subdividing it out, kind of doing some good work out here. So opportunity is key. And when you look at the cost of that opportunity, there's a cost, an economic cost to waiting when you're trying to think and better your future. Absolutely no one I've ever talked to that's made a lot of money and a lot of success has ever said, I did it by holding still and not making any changes whatsoever. Almost every single one of them said, I took a risk. It scared the bejeebies out of me, and then I got there.
I mean, there's that saying, right? You can't make progress standing still.
Yeah.
That's fact. That's in everything you do in life. Like, you stand still, you're not going to progress. Sure, you may feel secure standing in that spot and you won't fall back. Sure. I mean, there is that risk, right? There's always a risk. But at the end of the day is, how many times are you not going to say, oh, well, I'm not moving forward, but yet you refuse to move? So really, where's the problem?
Byron never won a drag race by pressing the brake.
Well, bracket racing, you might be able to like score.
All right, fine.
It's really about your time, and I don't like bracket racing very much, but I'm not gonna say I haven't done it.
All right. See, that's how much I
depends on the race type. We're talking about the type of race here. Drag race. On a drag race, you're not going to hit the brakes unless you're getting to that line.
All right, let's talk about additional VA loan benefits. We're talking about comparing the loan to others. VA loan benefit has some very specific things. One is seen in many loans. That's no prepayment penalty. The VA loan was one of the first ones to do it. And then after the crash, there happened to be a whole heck of a lot of no prepayment penalties. It was written into the whole qualified mortgage piece and what's can be traded and sold in the secondary market. So it's not as exciting anymore. Assumable loans, yes. Can the VA loan be assumed? 100%. 100%. Is it easy? Heck no. Remember that the VA, the actual Veterans Affairs, is not a governing body. It's an execution branch, right? It does the will of congressional oversight and directive the best that it can. So assuming loans right now is not easy, but it's awesome if you can get it done right. And then the VA loan also has the streamlined refinance option, which Jerry popped in on briefly. Do any of you guys want to keep going on that? Because frankly, I think we're looking at a big season of IRRRLs coming up, depending on what rates continue to do.
I mean, so the IRRRL, everybody, interest rate reduction and refinancing loan. Did I get it right?
Interest rate reduction, refinance loan. Yep.
All right, I got it right. It's honestly, it's the best tool a veteran has to be able to save themselves money per month. It's not magic. Like, look, you guys are going to see, the world is going to see, if you haven't seen it already, when they started hinting at the market was going to get better for us or for everybody. I saw so many loan officers throw up that super low rate in the fine print, have a bunch of points buying in it. That loan is built to defeat that kind of bait and switch advertising.
Mhm.
And it's the veterans, it's in the veterans' best interest if they bought the home in the last 2.5 years and have a, maybe they bought their home with some shaky credit or whatever. If they got a higher rate, this could save you money per month right off the top. Not even talking about the initial savings of not having a mortgage payment for 2 months and getting your escrow back and stacking, that little wad of money to start with, and then saving yourself however much a half a point saves you a month.
Yeah,
or more.
And speaking of experiences in that particular topic, right? When it comes to the IRRRL, guys, the minimum requirement on an IRRRL is you have to wait 210 days. Your interest rate has to come down by 0.5%. But guess what? A lot of times right now, specifically speaking right now, there's rates that have come down 1%, or 1.25%. I did one where the percentage was, I think, 1.25% better or 1.5% better than where they started at. But the total amount of savings, and I bear in mind, this is in San Diego, right? So we're talking about, it's a large loan amount. We're talking about $800,000.
Yep.
The savings difference was almost $1,400 a month.
Holy
just
smokes.
because of that,
Wow.
that shift in rate. And yet still people will hold on and not refinance because they say, well, I'm going to wait till the Fed drops. Well, guess what? It's the market's already built that in.
Yeah,
The
nobody
market
knows what's
already
going to
built in
happen.
that savings. Yes. So you wait till September. Guess what? Now you're waiting even longer, and you're probably going to catch a slower moving train, but you're still going to catch it. And
Maybe.
like I tell most people, it's at this point, you better hope that nothing economic blows up, because then we could end up seeing the rates worse. And then that opportunity you have had in saving $1,400 a month now just went bye-bye. And I'm not talking about principal PITI, right? Or principal, interest, taxes, and insurance. I'm talking about principal and interest only. That's $1,400, dude. Like, that is nothing to snooze at. That is nothing to snooze at. Do not wait. Do it. Act now, because at the end of the day, trust me when I tell you this, people that tend to wait and hold on taking action always end up regretting it. Always. Yeah. Hindsight is always 20/20.
I would say always, but that's just because I'm not an absolutist, Jerry. But I will agree.
I'm an optimist.
I'm an optimist too, to a large degree. Look, I'm not going to argue the point that waiting comes with risk, just like action comes with risk. I just prefer to usually be moving when that risk hits me, so at least I can be flexible. That's what I choose to do. To Byron's point, and we need to hit this again. The markets, smarter people than the three of us combined, sit and watch markets and look at historical data and expectations of international markets, and they can numerically call out what's about to happen so many times. It's just all in what you have to understand, like about me. When the Fed cuts rate, it affects your interest for your savings account and how expensive it is for banks to borrow money. There is no guarantee it will affect your mortgage rate. Mortgage rates are dedicated on where the markets, the big markets, are moving money to the 10-year treasury bond. And when they start putting more money in the bond and that bond spread comes down, it was floating to near 5% earlier last year. I think it's around 4, under 4 now, and it's floating. When that starts coming down, that spread, our interest rates start coming down. That's what we're watching. So if you're sitting here on the cusp of going, oh man, I got quoted something, it was really good, but man, I'm waiting for the election. I'm waiting for the Fed meeting. I'm waiting for the next thing. It's like, look, people that make a lot of money and move billions and billions at a time with the flip of their wrist, they already expect what's going to happen. They're already making plans for it. So if it makes sense for you now, do yourself a favor and get done what you can. If you try to wait to the bottom of the market, with your home, you're going to miss out. You do that with your milk money. Milk money is what you invest, because if you lose it, you're not sad about it. I mean, you're sad about it, but it's not going to kill your family. Your home, you don't mess with like that. So, and then when you get it and you're happy with it, you hold on to it for everything you got, and you just ride that wave. So that's a big takeaway for this evening. Really glad you brought that up, Jerry. Really glad we talked through that a little bit, because yeah, I hate watching people kind of wait too long and miss the actual market point. We talk about other misconceptions, common ones. We talked about this in some of the other videos, but just a quick hit. VA loans take longer to close. Byron, what's your average rating on a closing of a VA loan right now?
I mean, we're at 22 days. And I can do it. 22 days is, I asked for 30, but my average is 22 days, and I've done loans down to the 17. So the appraisal weirdness, that's kind of like in Washington, that's a thing. So depending on how fast my appraisal comes back, it could be faster. I've seen my boss close stuff in like 11. So
so a lot of times, like, you get in this now, we're not talking, hey, I'm applying with you and I close them a home in 30 days. What we're talking about is I applied, get pre-approved, I go through that process, and then I put in a contract with a vetted VA realtor or some other trusted agent that's helping me. And from the time that contract is signed by all parties and executed, 22 days for Byron. Jerry, what are you running?
So are we asking just the average, or are we talking about what's the fastest versus
kind of your average?
So the average is right around 22 days or so, 21, 22 days. And I think that the only times that my transactions ever go the full 30 is because the seller wants to wait the full 30.
Or the buyer, because the buyer's
sometimes the buyer, sometimes the buyer just needs it because they're moving out and blah, blah, blah. But for the most part, I notice it, at least in the transactions that I've been a part of, it's a lot more of the sellers not wanting to close sooner, because they need to occupy the home longer, and they don't.
I get that a lot.
Yeah. So because of that, the transaction will, sometimes have to go longer than I would be able to close it in. Right. I've had some that within, I think it was the fastest one I think I did was like 7-8 days, but it was such an easy transaction. It was butter. I could not believe it when I went through it. I was like, wow, like appraisal was done within 2 days. Conditions or the application with the full disclosure of documents, the conditions were all like, there was all of 2, so the transaction literally just flew. And so I would say this: it's amazing.
Any veteran active duty that's watching this, family member, you're kind of like, what do I need to know for our next purchase? If you're working with a vetted VA loan officer and real estate agent, and either together or just independently, and they're like, hey, we're ready to close. I know it's like 5 days early, but don't freak out. You're not in trouble. Like, it is not uncommon for us to say, hey, we're done, because we're good, very good at what we do. And then that's actually where I've had some of the most anxiety is we're literally done a week ahead of time. We're like, hey, we're ready to close whenever you are. And even the realtors are like, what's wrong?
Excuse me.
Nothing.
Are you sure? Did you miss something? Did you miss something?
Yeah, sir, ma'am, nothing is wrong. We are good to go. You are good. Like, we are solid on this one. So who you work with matters. Vetted VA professionals are definitely the top of the top. We don't throw the word around expert very often, but I will say they are experts at troubleshooting whatever may come up. Let's put it that way. And they're experts at double checking all their information that they have. One of the other common misconceptions is that sellers don't like VA loans.
I feel like that is a very area specific thing. Like, I live in between 4 bases, like in under 100-mile area.
Yeah,
there's 4 bases, and as soon as you go past like Renton and go towards Seattle, VA loans get weird. People in Seattle, I don't know. It is what it is. Stuff and things. Maybe they don't like veterans. Who knows? But once you get to the north end of Seattle and start going back up towards Whitby, it gets better VA loan wise. And the South Sound gets it. They all know, hey, the military isn't going anywhere. You guys are going to be here forever. Let's help you get into homes. It's really a area. I feel like it's like a misconception.
Yeah.
Very area specific misconception.
Yeah,
It is.
I have to agree
I'm
with
happy
that.
to say it. Go ahead, Jerry.
No, I was just going to say I totally agree with that because you'd be surprised how many real estate professionals are just not knowledgeable on the VA loan. So they just because of they've been kind of trained to just be like, we'll put them at the bottom of the stack, but it's really because it's a lack of training. I'm sorry, your ignorance is not my responsibility to have to pay the price for, right? So now it's like, let me educate, let me help. And typically when you get through that phase of educating them and helping them kind of get that line of sight proper, then all of a sudden it changes their dynamic, because now that all of a sudden they're like, I love VA loans. Why? Because they're so flexible. And at the end of the day, the things that they fear the most are typically the fact that you're looking at, oh, well, we got to do termite in certain areas, right? In certain areas or regions of the country, you got to do termite. We're worried that it's not going to meet the minimum property requirements. Well, have you even looked at what the minimum property requirements are? Probably not. So let's go over those, right? And so then it's breaking down all those misconceptions, and then all of a sudden it's like, oh, okay. Well, in those situations where the property is a little bit not in the best condition, guess what? We got the rental loan. We can fix it. We can make it work, right? And so there are methods to the madness. It just depends on whether or not the realtor is open to have that discussion, and then ultimately be able to educate their sellers. And
I've
that's
had that discussion before, though. Like I had a client PCSing in, or not PCSing. The lady had got out, and she's moving up to Seattle to be a doctor or something. I don't even really remember, but I remember talking to that seller and like, hey, look, here's my YouTube channel. Go check out all these loans on the VA loan. This is a great product. This, that, the third, whatever. This lady, she talked to me, and then she told her clients, it's a VA loan. I don't know if it'll be whatever. And my client still lost out. And it absolutely upset me. I was going to say, good buzzwords.
No cussing. Yeah. No cussing.
I didn't.
No, you did good.
You did
good.
Is Barbara still going to do push-ups with me if I swear? Because that was the deal in the group chat.
I didn't see that, so I cannot attest to it, but I'm pretty sure Barbara can out push up you if that's the need.
But I lost out because of a agent's preconceived notions on the VA loan, because Seattle's 60 miles away from any base, and they don't get to see the VA loan like I see the VA loan every day.
Yeah. That's a good point. Regionally, it can be also depends on the I find it depends on the size of the town and how many agents are really engaged in that town and active. So,
Chris's comment.
Yeah, Christopher Griffith has called you out, Byron. If you slip out here, you're doing 50 Marine Corps push-ups for a slip up. So I know
that must mean I have my favorite little shorts on and my fingernails painted. And Marine Corps.
Jerry and I can't say anything about it, but we get the reference. We're gonna laugh.
All I can do is laugh. All I can do is laugh.
All right, dudes, we got just about wrapped up here. Conclusion, really, let's tie this down, right? So take this home. Is the VA loan really the most expensive loan out there?
No.
Absolutely not.
Okay. I mean, I think if you go back and watch point by point, it just makes sense that the VA loan offers the most flexibility, the lowest cost, the greatest amount of seller concessions,
some of the best terms.
Some of the best terms, right? And interest rate points, and APR is also there, which means it just hands down makes more sense. I personally would love to see so many more veterans who have earned this product. Now, my dad is a Vietnam veteran. I'm super proud of him. Served on the Midway, and he's using this to build a house, his retirement home. And it's one of the first times he's ever used it. So I'm very proud of him for doing it. Really, there are so many stories out there like that need to be done. Like the older couple, he's looking at his retirement home. He bought it as a teacher, used his VA benefit for the first time. Use it. It is amazing, especially in a marketplace like this. It's competitive. It's arguably one of the very best loans that can fit anybody. And if you're having trouble with it, professional or veteran, active duty service member, and family alike. If you're trying to use this in any way and have trouble, come to VetaVA, the Facebook group. Come to VetaVA for professionals only in the Facebook group. For the pros, ask your questions. Let us help you overcome the challenges, overcome the obstacles, get over that all the way together and win you that house, because this is what this group is here for. If we help you personally or not, it doesn't matter. If we help you get into a home, that's our mission. So let us fulfill that mission. Don't feel weird about asking for help. We're here. So appreciate you guys. Any last words?
Byron Thomas, 2024, veteran and loan officer.
Yeah, I don't got a slogan. I'll just tell you guys. Don't be scared of moving forward. That's like right now with the rates the way they are, things are already being baked in. So please take notice of that. The prices and costs and adjustment to those current rates that are out there right now are already baking in that difference in what the Fed will do in the near future. And again, like Nathan said, that is mainly affecting banks and what your savings account will work with, right? That is literally it. But it does have a trickling effect into what we do. And so ultimately, like I tell you, it's already there. So don't wait for that moment to come, because just like this other individual may or may not move forward right now, if they decide not to, hey, I at least said, here are your cards. They're all laid out. Take the time. Do it.
So my parting word is going to be brisket queso. It's delicious, and if you're in Texas, you need to get some. It is phenomenal. Brisket queso. So
Endorsed
there you go.
by Nathan.
Endorsed by me. I love brisket queso. You can tell because Byron and I are basically the same size, but he works out a heck of a lot more than I do. So there we go. Y'all, thank you so much for being a part of this call, watching it and recording or live. Appreciate you. I've put some links in there. Check them out to our Debunking VA Myths white paper. It is available for anybody. If you're a professional and you want to share this, please share it. Please post it on your website. Just promise me, and do not put it behind a contact link spreadsheet where you get to solicit business if they download it. This is meant for all people with freedom of access of information. Pass it around. So thanks y'all for being here. Have a great night.